Hello everyone, welcome to the third video. This one is around credit sales and just some more challenging entries when we are doing the new debit and credit concept that we've just learned. So this one is just a continuation of the sales. This time we're thinking about a credit sale. So again, I know you've done all of this last year, so it really should just be a refresher. So a credit sale is one where the customer takes the goods and promises to pay at a later date. This is still a revenue transaction, exactly like we did at the end of the last video. An inflow of economic benefits in the form of an increase in assets that leads to an increase in owner's equity. Do not forget, you need to be all over these definitions. The fact that the cash has not been received does not mean that the sale is not a revenue. It means that when we're thinking about a revenue, it just has to be earned. So if we've given the goods, we've earned that revenue. Those people are obligated to pay us. So the only difference from a cash sale is that instead of creating a cash, including cash or bank in the transaction, we now need to include debtors in the transaction. Again, just like stock, this is now called debtors control. You must include control when you're writing down debtors from now on, every time. Okay, so we're going to do another transaction. This transaction is going to be on the, so I'm going to write the date in, 16th of Jan. Now, again, instead of thinking about the bank, because we are not increasing the amount of money that we've got, we need to increase our debtors control. So we need to increase debtors because these people now owe us money. So it's increasing the amount that they owe us. We are entitled to more money, so it's an asset. It's going to provide future economic benefit. Increasing. We know that to increase an asset, we need to debit. So let's do this one as 1,200. The rest of the transaction is exactly the same as what we did above. So if we're thinking about this one here, we still need to have sales, and the bottom half is still exactly the same as what we did in our cash sale one. So we've got sales. That is a revenue. Oops, sorry. Increase. To increase the revenue, we credit the amount. The other half of this one is going to be exactly the same. It's the amount that it cost us to make the sale. So cost of sales, which is an expense, increasing, and the cost of this was 680. The other side of this one, our stock is going down because we are giving away stock. We are selling stock. Asset, decrease. To decrease an asset, it is $680 in the credit side. So then we just add it in. Our debtors control needs to go on the debit side. We know that because we did it up here. This one's on the 16th of Jan. This one needs to be the other side. So if we're thinking about debtors control, the credit as a result of this debit that I'm entering is sales for 1,200. Down here, 16th of Jan, when we're doing the other side, so that if we've got our sales, the debit side to this credit transaction that I'm entering is debtors control for 1,200. We keep going down. Cost of sales, the 16th of Jan. The other side of this is stock control. This is the debit side. The credit as a result of this debit is stock control. This one was 680. Yes, 680. Lucky last, 16th of Jan. The stock control in the stock control account. The debit as a result of this credit is going to be cost of sales and 680. That's it. What I would like you to do now is have a think and write down the effect on the accounting equation. So assets, liabilities, and owner's equity. just like we used to in the space provided. Okay, so if we've done a credit transaction or a credit sale, it means that these people are eventually going to have to pay us. When the people eventually pay us, cash is coming into the business and we have to record this. So the debtors no longer owe us any money. If the debtors don't owe us any money, then we need to make sure that we're decreasing the amount in the debtors' control because they don't owe us that anymore, so it's not going to be a future economic benefit. Okay, this cannot be a revenue because it doesn't fit the definition. So no revenue accounts are going to get affected. Inflow economic that increases assets and in turn increases owner's equity. This is not going to affect owner's equity. This is going from being a debtor, so being the amount that they owe us, to money coming into the bank. So it's only affecting bank and debtors' control. The revenue is counted at the time the sale was made. So when we're thinking about revenue, this is when the revenue was recorded for this transaction. So all this one is saying is they paid us on the 31st of Jan. When we're thinking about this, we know that the bank is increasing. These people are paying us. So we know it's an asset account. It's increasing. Oops. Increasing because there's money coming into the bank, so more money in the bank. And they have paid us the amount that the transaction was for, so 1,200. They owed us 1,200, now they've paid us 1,200. That means on the other side, we've got debtors control. This is also an asset. However, this is decreasing. They no longer owe us this amount of money anymore, so we need to decrease the amount in that account. If we're decreasing an asset, it's 1,200. So we've got on our bank side, money coming in has to be a debit. We know that because it's up here. The other side of this transaction, the credit as a result of the debit that I'm putting in, is debtors control. If we go down to debtors control on the 31st of Jan, the other side of this credit transaction is going to be the debit transaction. Oh, sorry, I didn't put the amount in. So the other side of this credit transaction is the debit transaction, which is the bank. That's it. So really it is just thinking about this analyzing chart. If you've worked it out here, then it should be very easy to transfer down to the actual T-ledger accounts in the general ledger. Okay. Last one that I'm going to do for this is drawings. So while drawings is relatively simple, it becomes a little bit more complicated when we're talking about it from a debit and credit perspective because it is a negative owner's equity account. Kind of a little bit like expenses, really. We know that to increase owner's equity, we need to credit the account. It's on the right-hand side of the balance sheet. Anything on the right-hand side, you need to credit the account. However, drawings needs to do the opposite. It's a negative. When it increases, owner's equity decreases. Same as expenses. So that means that to increase drawings, you need to debit the account. Really important. So don't forget to increase drawings. It's a little bit different because it's negative, just like expenses. So you need to debit the amount. So I've got an example already written here for you. On the 7th of Jan, the owner takes drawings. So it's drawings. The type of account, I've just written negative owner's equity there so I remember. We're increasing it. The more you take out, the more you increase drawings by $500. So I know that because it's a negative, when you increase drawings, overall you decrease owner's equity. Therefore, I need to debit it. The bank is going down because I'm taking money out of the business, so it's credited. The one other way that you can think about this is because we know that it has to be a debit and a credit for the one transaction, bank has to go down because we're taking money out. So it is definitely a credit. That means, as a consequence, drawings has to be a debit because you can't have two credits. So if the other side is a credit, it must be a debit. Exactly the same deal on the 10th of Jan. We took out some stock to use, or the owner took out stock to use for his personal use. Negative owner's equity, it's increasing because we're taking more out. So the drawings amount, the amount that we're drawing out, is going up by 2,000. Stock control is an asset. It's decreasing because we're taking stock out of the business. To decrease an asset, we are crediting the amount. So again, it's already all done for us. We literally just have to chuck it in. So drawings on the 7th of Jan. The opposite side of this debit is going to be the credit. So I know that the credit that's happening is going to be bank, and it's $500. Bank, we are decreasing the amount in the bank. So the 7th of Jan. The other side of this transaction, the other side of this credit is going to be the debit in drawings for $500. Same deal with this one, 10th of Jan. We've got the other side of this debit is going to be the credit, which is stock control. You know, the other side of the debit is the credit, stock control, 2,000. And then down here on the 10th, we're going to do the other side of this transaction. So the other side of the stock control, the debit as a result of the credit is drawings, 2,000. That's it. All right, I'm going to pause it here and make one more video about trial balances and balancing.